So he doesn't like special dividends, but he's committed to increasing dividends. How does his base case, from what we know so far, about what happens with this massive cash pile, meet your expectations?
I think it's all still about returning money to shareholders. I mean, one of the things when they issued that huge release after the tax relief, where they were saying, hey, we're going to pay the government $38 billion, was investing more in the U.S., and they said, wait to see what we're going to spend on CapEx. The CapEx didn't change at all. So maybe they're shifting something within CapEx, but there's no actual incremental investment that the company's making, which means that they have $125 billion of cash that if they want to go to cash neutral, if they just bought at today's stock price, they could take in 15% of the stock. So it's all about buying the stock back. Maybe it'll take a period of time. Maybe it won't be special dividends. Maybe it'll increase the regular dividend, but it's all about returning cash to shareholders.
What's your base case for what that capital return plan looks like? We had a guest on yesterday with a huge assumption, looking for something like $300 billion in a brand new capital return program. Is that much higher than you're expecting? Lower? Where are you?
Well, we're not going to find this out until probably late March or April. That's typically when they come out with these things. But this company generates now $80 billion a year, right? And they're only spending $15 billion on CapEx, another $15 billion on dividends.
Yeah.
So that gives them a good $50 billion per year of free cash flow just to use for share repurchase, let alone the $125 billion that they have sitting there that they want to get to cash neutral. So those are numbers that can certainly happen. 125 gets them 15% of the float reduced at the current stock price. So if they spent that other $50 billion a year, you could talk about a major share reduction from one of the largest companies in the world.